Welcome back to the Capital Breakdown. Today we're digging into a question that trips up a lot of people. Is now a bad time to start investing? Maybe the market feels scary, or maybe you're hearing about downturns and wondering if you should just wait for a better time. But here's a twist to think about. If today is the worst possible time to start, what actually happens if you wait? In the next 12 minutes, we're going to break down the mindset and mechanics behind market timing, why getting started is often the hardest and best step, and how to build a foundation that can help you stay on track through all kinds of market weather. Let's jump in. First, let's talk about what market timing really means. It's the idea that you can predict the best moments to buy or sell investments based on where the market is headed next. Sounds great, right? But here's the catch. Even the pros struggle to consistently pick perfect entry and exit points. The market is influenced by countless factors: economic data, geopolitical events, investor emotions, and more. Trying to perfectly time your investments is like trying to catch a bouncing ball with your eyes closed. It's unpredictable and risky. That's why many experts encourage focusing on time in the market instead of timing the market. Now, what happens if you wait for the perfect moment? Waiting to invest can feel smart, especially when headlines shout about volatility or downturns. But the problem is that perfect moment might never come. Markets go up and down, often unexpectedly. If you wait too long, you risk missing out on the recovery phases or long-term growth. Historically, some of the biggest gains happen in short bursts, often right after market dips. By waiting, you might miss those key opportunities. So, the real risk with waiting isn't just market swings. It's missing the chance to let your money grow over time. Let's put this into a simple analogy. Imagine planting a tree. If you wait for the perfect sunny day, you might never plant it. But if you plant the seed today and care for it consistently, it grows over years, weathering storms and droughts. Investing works similarly. You're planting seeds of capital that, given time and patience, can grow and compound. Even if the market looks stormy, those roots can get stronger. Starting earlier means more time for your investments to recover from downturns and benefit from the power of compounding interest. It's also crucial to consider your personal goals and time horizon. Are you investing for a house down payment in a few years? Retirement decades away? Different goals call for different strategies and risk levels. The key is aligning your investments with your timeline and comfort with risk. If your horizon is long-term, short-term market swings matter less because you have time to ride them out. But if you need money soon, you might prioritize safer, more liquid options. Either way, understanding your goals helps you stay grounded and avoid panic when the market moves. One of the best ways to ease into investing is through diversification. That means spreading your money across different types of assets: stocks, bonds, real estate, maybe a broad market fund, to reduce risk. Concentrating all your money in a single stock or sector can be exciting, but it also increases the chance of big losses if things go wrong. On the Capital Breakdown, we always emphasize that diversification doesn't eliminate risk, but can help manage it. It's like not putting all your eggs in one basket. If one basket drops, you still have others safe. You might hear a lot about different investment tools: ETFs, index funds, bonds, even options and futures. ETFs and index funds are popular because they offer broad market exposure in a single package, often with low fees and built-in diversification. Bonds typically provide more stability and income, but usually lower returns than stocks over the long term. Options and futures, on the other hand, are more complex and can carry higher risks, especially if used with leverage or speculation. For beginners, understanding these basics is important before diving in, and risk awareness is key for all investments. Getting started doesn't mean you have to invest a big lump sum right away. Many platforms now allow small, regular contributions, often called dollar-cost averaging. This strategy means you invest a fixed amount at regular intervals, regardless of market ups and downs. Over time, you buy more shares when prices are low and fewer when prices are high, which can smooth out the average cost of your investments. It's a practical way to build your portfolio steadily without trying to guess the perfect time to jump in. Mindset plays a huge role here. Investing isn't a sprint, it's a marathon with plenty of twists and turns. Staying calm during market drops and avoiding emotional decisions can be tough but is essential for long-term success. Remember, every market downturn in history eventually gave way to recovery and growth, although past performance never guarantees future results. Building confidence comes from education, planning, and realistic expectations. The Capital Breakdown encourages you to view investing as a tool, not a gamble, to help meet your financial goals over time. Now let's address risk again, specifically around single stocks and leverage. Single stocks can offer high growth potential, but also come with high volatility and company-specific risks. Leverage, using borrowed money to invest, can amplify gains but also magnify losses, sometimes dramatically. Options and futures add complexity and risk that may not suit every investor, especially beginners. Being aware of these risks helps prevent surprises and support smarter decisions. If you consider these tools, make sure you thoroughly understand how they work and the potential downsides. Another important piece is doing your own research and, when in doubt, talking to a qualified financial professional. No one knows your personal situation better than you, and professionals can help tailor strategies to your goals, risk tolerance, and timeline. It's tempting to follow hot tips or trends, but solid investing comes from a thoughtful, informed approach. Use reliable sources, stay curious, and don't be shy about asking questions or seeking guidance. Your financial journey is unique, and having trustworthy information is a powerful asset. So wrapping up, is now a bad time to start investing? The answer often depends on perspective. Waiting for the perfect moment can mean missing valuable growth opportunities. Starting early, even in uncertain markets, allows your investments time to compound and recover from dips. Focus on your goals, diversify to manage risk, keep a steady mindset, and remember that investing is a long game. The Capital Breakdown is here to help you build that foundation with clear, practical insights, because controlling your financial future starts with taking that first step. Thanks for joining this episode of the Capital Breakdown. Remember, investing is a journey, not a race. Keep learning, stay patient, and make decisions that fit your unique situation. And as always, do your own research and consider talking with a qualified professional before making financial moves. Here's to building your financial confidence one step at a time. See you next time. Thanks for watching the Capital Breakdown. Remember, this is education, not personal investment advice.